The pump continues. Thank you for joining me on today's Monday market update, everyone. I'm just going to cover a few larger topics that are affecting the market right now and also show you a couple of charts. But another massive week on top of last week, and it is shaping up again like we're going to see continuation. And I'm just going to paint here a very simple weekly chart, just the broad picture, and we can go from there. So very clear to me that after this bullish engulfing candle, this massive green candle that we had here that really broke out from this wedge, and the lows of Bitcoin, we can see that this last week, we've just followed on from that one. So big one there, next one. So this is a move of, let's say at the breakout, let's take it. This is a 32% move, give or take right now. And the market is responding really positive. So that's what we really want to see. What is next though, and what everyone should be paying attention to, is the 200-week moving average, which is this red line here, runs through everything and then just comes in here confluent with the horizontal here. So the 200-week moving average and the horizontal line here, just marking that breakdown from Luna back in the day last June. Also probably running in line with when we have the Federal Reserve make their interest rate decision on the 2nd. So just amazing confluence of different things moving there. That's where I see this price gravitating towards, hitting it like a magnet. That's where we really see whether this is a rally that's going to continue, or are we going to see a massive sell-off in this area, bringing us back to these levels here? We could also see both. They're not mutually exclusive. So we could run into it, have a big sell-off, and then we come back and roll higher. My inclination is we keep rolling. This is a really strong movement in momentum. So we're just going to throw it out there. If this is a repeat of 2009 as well, or at least it's going to rhyme, this is how, if you can see the bars here that are just shadow behind, you can see the green lines. Now, obviously, we're not following it exactly, and nor would I expect it to. But you can just see how it just never let anyone who wanted to buy the dip get in at their preferred price. The momentum just continued to carry, broke up through multiple flags, also ascending wedges, just continued high, blitzing through short positions and carrying it high. This is what we really want to see here. And likely what happens at 25,000, we see a lot of sellers come in, we see shorts pile in like crazy, and then bulls could surprise everyone. And we see a lot of spot buying on the market that rips through those shorts and just rockets us, to 30,000. So that is absolutely on the cards. Just want everyone aware of that you really want to be careful fading strong momentum, especially when we've seen such a long protracted period of downward pressure. And then we see the market is trying to tell us that this is a change in trend. This is a change in momentum. And we just want to be really careful about what we're doing, and recency bias. We don't want to be taken in by what happened last year. This is a new regime. This is a new year. So just keep that in mind. But just zooming out, you can see how important the 200-week moving average is. Going back doesn't quite continue. This is just on Bitstamp. I could go to another chart, but you get the picture. Market structures have long held on top of it or gone beneath it for a small period of time. So just keep that in mind. So the 200-week for me is the key to unlock greater gains to the upside, and maybe that blow off in a melt up 2019 style. But the market is positioning for that. So I just want to keep everyone on top of that. Don't want to sound uber bullish. I'm really not trying to sound uber bullish. I'm just playing the ball where it lies, because we can get caught up in macro bad, in bull and bear markets and all that. But if you're just looking at the on-chain data, the charts, rubbish sentiment for so long, recency bias, all that, just play what you're seeing. If you play your risk profile, if you see an opportunity, go for it. But just make sure you are managing your risk. So that's what I see. Potentially with Bitcoin there. Also, what's happening here is so important, and why I have a bit more confidence in at least Bitcoin, not altcoins just yet. I really want to wait for that 200 weekly to be taken out, and we might see an inflow of liquidity. Right now, it's really just Bitcoin and Ethereum just leading this. Ethereum, again, not so much. So it's just a Bitcoin driven thing. But we've taken out what is known as the realized price level. So that was at 20,000. We've also taken out the short-term holder average buy price level, which is about 17,800. So that was taken out really early. That was my first yes. Realized price is a second massive yes. That's the average cost basis for all investors. You can just see here, whenever we've been under it, has been a point of maximum financial opportunity. We don't stay under it long during these cycles, and we're often on top of it, trending upwards. So that is super important. And where are we now? Well, we had a bit of maybe an artificial suppression underneath it with FTX. Now we've popped back above it. Now we're starting to rise. And what is super, super important that just happened as well with the break of 22,500 was we're now on top of a long-term holder average cost basis. So essentially everyone is now in profit, barring a few outliers here and there. That is massive for this market, because historically we have seen once we're above those levels and we do see a cross of essentially the long-term holder and short-term holder averages on the chart, you'll see the lines cross over. When we see that crossover on the back end, we saw the crossover here, which indicated probably the capitulation. When we see the crossover again on the other side, that means we're trending up into a new phase out of the bear market. So just keep that absolutely in mind. Now, why the upward movement of the market is likely to continue in my eyes in the macro is because the Federal Reserve have leaked to the Wall Street Journal on the front page that they're set for a mild interest rate rise in February. So that means instead of 0.5, they'd like to come back to 0.25. That should give markets tremendous confidence going higher. As well, they have indicated they're looking to pause potentially around spring. So this should, in all honesty, this should make the S&P 500 and NASDAQ rip through that 4,000 point line. This is hyperbolic, just don't really look at that, but I just wanted to show this article. It should really see upside for the S&P 500 and NASDAQ. And if we see that, Bitcoin should happily go to that 25,000 and likely above it. And that's when we could see that inflow of liquidity, as all the participants are sitting on the sidelines and stable coins or sitting in their bank account go, all right, well, risk is probably going to see a bit of an uptick here. And it's actually when the Fed decides to pivot, which means cut rates, which likely happens maybe toward the end of the year or next year. We just don't really know. Historically, when they've gone into a pivot, we see the drop off in markets. So just keep that in mind. A lot of people on Twitter get a little bit confused about how all that flows, but historically, that is what my understanding is how it rolls. And markets do rally into recessions and into pauses, almost like a buy the rumors, sell the news type of thing. And when the pivot actually happens, it's the actual news when it happens. So. And essentially when it happens is everyone's kind of looking around going, oh God, now we're actually in a recession and the happy times are over. But again, we need to be careful getting stuck in preconceptions of what is actually going to happen and just play the ball where it lies. Keep things super, super simple. It's what I've been reiterating to our mastermind clients. Don't get caught up again in macro and over analysis and all that. Play the ball where it lies, and right now it's reasonably obvious that the market wants to creep higher. Ethereum, looks actually quite fantastic, if I'm honest. Has shown relative strength against Bitcoin for a very, very long time. Didn't even make that second low like Bitcoin did in the FTX collapse. So for me, if Bitcoin makes another run, or at least go sideways for a little while, and we can be reasonably confident that it's still trending higher, looks like Ethereum wants to catch up here and have its own break up of 1,700. Watch that very, very carefully. I'm seeing a few momentum indicators telling me that it's starting to get a little overheated, Ethereum as well as Bitcoin. So just be prepared that there could be little pullbacks or even large pullbacks. We just don't know in this regime with lower liquidity. So just be careful. Same with Bitcoin. A very obvious point for me for a pullback to get very interested is around about the 200-day moving average, which is sitting around about just under 20,000 Bitcoin. I'd be surprised if we go under 20,000 just based on the momentum that we're seeing right now in the short term. But that doesn't mean we can't have a massive rally 2019 and then we're back to 20,000, when the Fed does pivot, or if there's a black swan event. We just cannot predict everything, but just have the scenarios in your head about how you're going to play it and what happens. Another point as well in the macro is the US is reaching its debt ceiling, about to negotiate. So that just means printing more money, means things are still getting, completely going out of control. The QT and all that. The US is not cutting their spending. In fact, they've never needed to spend more. They're never going to spend more than they have at this moment. They're going to raise the debt ceiling again. That means printing more bonds, creating more debt, going like crazy that way. The world is onto it. There's also rumors that some countries are starting to create their own currencies, which we do dive into in the mastermind group, but I won't go down that rabbit hole here. Also, a bit of bearish news, just wanted to cover off real quick. A lot of traditional financial accounts that are particularly bearish on crypto have been really running with this without much backing it. So I just want to hit it on the head, saying that Swift will no longer process currency transfers for anyone under $100,000 worth from banks to, let's say, a Binance exchange. This is true in a very small sense, and that is one bank, and that is Signature Bank. Binance alerted to everyone using Signature Bank that Signature Bank is actually doing this. So they're stopping all retail transfers. This is a bit of a warning shot across the bow, I think. So we just have to be mindful. But right now, this is not a swift action thing where it's all Swift banks. And it would be pretty devastating if it was, because Swift is the messaging service between every single bank and central bank on earth. So it is a big deal if it does go down this route, and it is an attack vector we have to be a little bit concerned about, is those on-ramps of fiat. But again, it's okay for rich people to, throw their money at the market, but it's not okay for, you and I to do it or whatnot. So just keep that in mind. Was there anything else I needed to say on this? I don't think so. Guys, have a wonderful day. We'll catch you again on Wednesday for the Altcoin Bible. Can't wait. Catch you then. Bye.